If you're in mediation and exhausted, you're not alone. It's tempting to sign just to make the pain stop. I get it, but rushing now can lock in choices that are very hard to change later, especially with taxes and pensions. Today, I'll show you two quiet traps that look fair on paper, but can cost you for years if you don't slow down. I'm Vicki Joern, a financial advocate with B Financial Partners. I help people navigate major life transitions, including divorce, so they can protect their future with clarity and confidence. Today, we'll cover the tax trap, what equal balances are equal outcomes, the pension puzzle, what you must get in writing before you sign, and 5 simple steps and a checklist, a 48-hour pause rule, and how to build a mediation binder so you can walk in and be prepared. You'll set up a binder that says mediation, and you'll have tabs inside of it. That's for those of you that like to hold it instead of it being online. I'd like to tell you a short story. I'm going to refer to the lady as Rachel, and she walked into a mediation well prepared. She had notes on the pension, the survivor benefits, the count list, the works. But by hour 3, she was drained. She agreed to a split that looked tiny, half retirement, half savings. Months later, she needed cash. Her half was mostly pre-tax retirement money. Every withdrawal was taxed. Her ex, mostly after-tax savings, more usable dollars now. On paper, it was equal, but in real life, it wasn't. So, the takeaway is when you're tired, good enough can become expensive later. So slow down. So trap number 1, the pension puzzle. Pensions are powerful, often overlooked. Here's what to pin down before you sign anything. Does a pension exist? Don't assume anything. Ask, confirm, and get official plan documents. What's the marital portion worth? Request a calculation of the marital shares and how it's valued. What are the survivor benefits? What percentage and for how long? Don't assume that you're still going to be on there when you thought you were. Get it in writing before you sign anything. If your spouse dies, do you continue receiving the benefit? What percentage? Is it for life or a set period? This must be in writing. Who can change beneficiaries after divorce? You need to know this. Don't go in saying, I think I'm still the beneficiary. That won't hold. Confirm it in writing before you sign anything. What are the payout options? Is it single life, joint and survivor, period certain? Each comes with a trade-off. Monthly amount now versus protection later. Also, question why the pension's value is easy to underestimate. Let's look at some math. Assume it's $1,500 a month. So if you take that times 12, times 20 years, assuming that's the lifetime of the pension, that's around $360,000 income. A modest monthly number can have or hide 6-figure value, so don't walk past it. Also, if there's quadro, nerdy. Work with your attorney to ensure the quadro or relevant order accurately captures survivor benefits. Cost of living adjustments, if any, and timing. Precision matters. If pensions are the puzzle, then taxes are the trap door. So let's talk about trap number 2, the tax trap. Let's keep this simple and practical. Pre-tax versus after-tax. Pre-tax is like 401k, traditional IRA. Taxes are due when you withdraw the money. After-tax is like a brokerage or bank account. Taxes mainly are on the earnings. The principal has generally already been taxed. You should question why equal balances aren't equal outcomes. A 50-50 split can still be unequal if one party keeps mostly pre-tax money and the other keeps mostly after-tax. Let's talk about an example. You see $300,000 in a 401k. Your ex keeps the $300,000 in after-tax savings. You both need $30,000. Well, if you withdraw it from the 401k, income taxes are due on most of it or all of it. Whereas your ex, who has the after tax, if they withdraw, it's only being taxed on the gains. The result, is it the same balance? No, it's different spendable dollars. I also want you to think about another trap, tax trap, house versus retirement. And what do I mean by that? You decide to keep the house or rental house versus taking the retirement 401k. So keeping the house, you've got to think about, what will I have to do? Do I have to take care of taxes, upkeep, insurance, and repairs, and still retire on income? Run the numbers and look and see if it's worth taking care of having that house or rental property, or if you should take a retirement account or in the split. Later, you got to remember that there could be required minimum distributions. Right now, it's 73. You also have to consider Social Security taxation, and Social Security is taxed. So you've got to look at this whole picture and what tax bracket you think you might be in. So plan now, not later. So I want to talk to you about a 5-step checklist. List every account and label, pre-tax or after-tax. You can either do it online or in a book, and it's called what you put on the tabs, what you're talking about. You look at health savings accounts, the cash value of life insurance, what the house is worth, or any rental houses. If there's pension, you need detail on that pension and the marital portion, survivor percentage, or duration. Who controls beneficiaries post-divorce? Don't assume that your ex is going to keep you on there if you're on there. Have it in writing. Compare after-tax values, not balances. Ask your team to estimate the spendable amount. Your team should be your attorney, your CPA or enrolled agent, and your financial advocate or financial advisor. Run a simple projection. If I need X dollars per year, where would it come from? And what tax would I take? This is so important. Also, there's what they call a 48-hour pause rule. When an agreement is on the table, pause for 48 hours. Sleep, hydrate, review with your attorney, your CPA or enrolled agent, financial advocate or financial advisor, your team. Don't sign anything until you've slept on it for several days, and make sure that everybody thinks it's in your best interest. So let's discuss some myths and common mistakes. First myth, it's 50-50. It's fair. Reality, only if the after-tax value and cash flow realities are comparable. A myth, I'm still the beneficiary. Reality, not unless it's in writing. Policy and plan rules can change post-divorce. Mistake, ignoring survivor options on pensions. Make sure you price the survivor benefit. If you give it up, know what you're giving up in the total picture. Don't just be frustrated and say, I just want it over with. It will be over with, but make sure your best interests are involved for the future, not just now. Another mistake, assuming you'll be in a lower tax bracket later. I see this a lot. I've seen a lot of people come out after they retire and they're in a higher tax bracket because they don't think about RMDs and Social Security. That's a big surprise. Run the scenario. Look at your plan. If you don't have one, I highly recommend that you work with someone to make sure your best interest for your future is there and being looked at. Again, this is called a mediation binder. You can also go online. You basically want to have tabs in there and quick places to put things in and to go to. Create a simple binder or a digital binder so you don't negotiate from memory. Have it all there. Tab number 1, account should be listed on it. Pre-tax versus after-tax. Tab number 2, pensions if they're already. Plan docs, survivor benefit detail, contact. Tab number 3, after-tax value estimates. Very important. Tab number 4, house and major assets, upkeep costs, taxes, insurance, and if you've got rental property or just property, all of this is very important to be in there. Tab number 5, questions for your attorney and your team. And tab number 6 should be your 48-hour pause checklist. Sign only after you review it. And on the lower third, equal on paper should be fair and real life. Keep this in mind. Write it there. Equal on paper should be fair and real life. My future. So just a quick recap. There's 2 traps that you need to be very careful of and cognizant of in divorce. The tax trap and the pension puzzle. Don't just divide numbers. Protect the after-tax future. When you slow down and ask the right questions, you protect your future and the people who depend on you. It's not just looking at now, it's your future. And if you have longevity in your family, you might have a lot longer future. So make sure you don't run out of money and assets. This episode is educational. It's not legal or tax advice that I'm giving. And please work with your attorney and CPA or enrolled agent to help you prepare the right questions and see the full picture. Also include your financial advocate or your financial advisor. To make this easier, please, if you're interested, download my 1-page divorce asset checklist. The link is in the description. And if you want a second set of eyes before mediation, book a short consult. And don't forget, I'm Vicki Joern with B Financial Partners. Be financially prepared for today and the uncertainties of tomorrow.